What's up, guys? This this session we're going to review chapter 17 and chapter 18. Chapter 17 is mainly about macroeconomic and industry analysis. Number one, what are the differences between bottom-up and top-down approaches to security valuation? What are the advantages of a top-down approach? We covered the same question in week 1 TA session. So in detail, a top-down approach is to analyze the global and domestic investment environment, which is the macroeconomy, and the main focus is on industry and sector. So analysts who follow a top-down approach then narrow down their analysis of an industry or sector to a single stock, given the expected performance of the broader economy. And if they follow the top-down approach, they will allocate the assets to broad categories like stocks, bonds, options, etc. Finally, the analysis focuses on specific companies within an industry or sector that has been identified as likely to perform well. So this is a top-down approach. First, macroeconomy, then sector or industry, and then finally specific companies. On the other hand, a bottom-up approach typically emphasizes fundamental analysis of individual company stocks and is largely based on the belief that undervalued stock will perform well regardless of the prospects for the industry or the broader economy. So in the trading community, we call this buy the dip. If you think the stock like Netflix drops for no specific reason and you buy the dip, you expect that it will return to the normal valuation level. So that's why we call it buy the dip. The major advantage of the top-down approach is that it provides a structured approach to incorporating the impact of economic and financial variables at every level into analysis of a company's stock. So one would expect, for example, that prospects for a particular industry are highly dependent on broader economic variables. And similarly, the performance of an individual company stock is likely to be greatly affected by the prospects of the industry. So this is the major comparative advantage of the top-down approach. Number two, according to supply-side economists, what will be the long-run impact on prices of a reduction in income taxes? So when we talk about supply-side economists, there are several keywords that you can keep in mind, like Ronald Reagan administration, and during Reagan administration, the word Reaganomics, and tax cuts, and Tea Party, and so on. So supply-side economists believe that a reduction in income tax rates will make workers more willing to work at current or even slightly lower wages, which is the effect of tax equivalence. Such an effect ought to mitigate cost pressures on the inflation rate, because we know that inflation is driven by two main sources. The first one is the demand for the major ingredients or final products. And the other is cost-driven, which is the wages, the cost of inputs, so in the Republican National Convention, Mike Pence is on the ticket to become the Vice President of the United States. And from his speech, we know that Governor Pence is a Reagan follower, and he conducted the largest tax cut in Indiana. Also related is the Laffer curve in the tax economics. Now, the Laffer curve proposes that there is an optimal tax rate. It's optimal in the sense that government total tax revenue is maximized at this optimal tax rate. If the tax rate is too high or too low, the government total tax revenue will decrease. So that's why supply-side economists call it optimal level of tax rate. Number 9, which of the following is not a governmental structural policy that supply-side economists believe would promote long-term growth in an economy? So when we talk about supply-side economists, we should keep in mind that they don't like taxes, they want tax cuts, and they like competition, which is the major part of the capitalism. And they want competition, so they don't like government influence. So a redistributive tax system is not favorable to the supply side economists, because supply side economists propose that there should be tax cuts to the entrepreneur. So a redistributive tax system favorable to the poor people is not favorable to the supply side economists. So when wealth is redistributed through the government's tax policy, economic efficiency is created. And for the supply side economists, tax cut is a better choice. The famous word Reaganomics means lower tax rate, and other supply side stimulations that keeps the economy growing from 1985 onwards. A promotion of competition is sure the favorite of supply side economics, and minimal government influence in the economy is almost the same as a promotion of competition. The minimal government influence in the economy, which sometimes are referred as the invisible hand. This notion is first originated from Adam Smith. The wealth of nations. Number 11. There are 4 industries and 4 forecasts for the macroeconomy. Match the industry to the scenario in which it is likely to be the best performer. First, housing construction. We know housing construction is cyclical, but interest rate sensitive. The interest rate is mortgage interest rate. So it will perform the best during healthy expansion, which has a steady growth rate. With rising GDP, mild inflation, and low unemployment. B. Healthcare. Healthcare is a non-cyclical industry, so it will perform the best during deep recession, when falling inflation, interest, and GDP happens. Also, the national income of the families will drop. So the health issues is a major concern, and the healthcare industry will perform the best. See, gold mining. Gold mining is a counter-cyclical industry, and it will perform well during inflation and money supply, and when money supply is huge. So it will perform the best during stagflation, when commodities and gold perform well. The major reason is that they are counter-cyclical, and central bank uses more money supply to drag the economy out of low growth. But in the same time, the money supply will make gold mining a good industry to invest in. D. Steel production. Steel is a major input of the automobile industry and other industries. So it's a cyclical industry. The cyclical industry will perform the best during superheated economy, because in this kind of economy, we'll need more cars, more houses, more skyscrapers, more bridges, more railroads, etc. Next, CFA problems. Number 2, an anticipated expansionary monetary policy has been implemented. Indicate the impact of this policy on each of the following 4 variables. A. Inflation rate. Expansionary monetary policy will sure increase the inflation. So it's likely to increase the inflation rate either because it may overstimulate the economy, or because the end result of more money in the economy is higher prices. Related to the previous question, the gold price will rise. B. Real output and employment. Real output and employment should increase in response to the expansionary policy, at least in the short run, because expansionary monetary policy is used to stimulate the economy. As the classical theory ISLM curve indicates, the IS curve is downward sloping and LM curve is upward sloping. The y-axis is output, and the x-axis, the horizontal axis, is the interest rate. So if IM curve shift upwards, the output and employment should increase, and the real interest rate should fall. So we solve C, the real interest rate should fall, at least in the short run. And D, how about the nominal interest rate? We know that nominal interest rate consists of 2 parts. On the one hand, the real rate will fall, but on the other hand, the inflation might rise. As the nominal interest rate is the sum of these two components, we cannot say for sure that whether nominal interest rate could rise or fall. Next, investment exercises. First, we look at the MBER business cycle data. This is the MBER business cycle data from 1854 to 2009. And this is the official announcement date, which is seriously lagged from the real turning point. So, how does MBER select the beginning or end of a recession? They define recession start at the peak of a business cycle and end at the trough. What period in US economic history was the longest expansion? The longest expansion is from March 1991 to March 2001, before the dot-com bubble. What is the longest contraction? The longest contraction is from October 1873 to March 1879. It lasts for 65 months. The major cause of this contraction is that before the crisis, the railroad industry investment is superheated. And like the dot-com bubble, there is railroad bubble. Although we don't call it like that. So this is the so-called, you can think of it as a railroad bubble. After the crisis, we see a new form of capitalism, that is monopoly and oligopoly. And after this crisis, we see those real tycoons in railroad, oil industry, and steel industry. Those names can be called upon really easily, like Rockefeller and Andrew Carnegie. Look at the announcement dates section towards the bottom of the page. How much of a time lag is there between when a peak or trough occurs and when it is announced? So there's a 5 to 20 month lag between actual peak or trough and official announcement. What implication does this have for investors? So the implication is that a fundamental law of investing is uncertainty of the future, which is quoted in Professor Ricci's lecture slides. Because even the MBER is seriously lagged in identifying the turn points, and MBER hosts hundreds and hundreds of top economists from all over the US. They are professors and those top researchers from Federal Reserve. So this tells us that the turning points are really hard to predict, and all those official opinions are made exposed. Number 2, use data from finance.yahoo.com to answer the following questions. Actually, the data is not at finance.yahoo.com anymore. The data is now moved to business.yahoo.com, which is like this. And we can see the medical instruments and supplies, PE ratio. This is the dividend yield, and this is the PB ratio. Does the difference in PB ratio make sense in light of their different stages in the industry life cycle? Yes, it makes sense. So why does medical instrument and supplies industry has a negative PB ratio? We know that price cannot be negative, so the book value is negative. Why the book value is negative? Because medical instrument is, in the life cycle perspective, a rapid expansionary industry, and it has a lot of risky investment because the fate of the whole company might sometimes hinges on the FDA approval. For example, Theranos, which should be a promising industry in the blood testing, but later it's proven to be a fake. So the valuation of Theranos drops from billions to zero now. Book value can be negative because the company put a lot of money into R&D or other expansionary investment, which is not profitable yet. And they have to refinance itself through external equity or external debt to supply its investment. That's why the book value is negative. But for the electric utilities, in the life cycle perspective, it's a mature industry, and it has very steady and dependable cash flows, no dramatic and significant growth. PB is low because P is normal, it's not overvalued or heated as in the biotech industry. And the B is certainly large because the electric utility industry has a very large asset. Now look at each industry's price earnings ratio and dividend yield. Again, do the differences make sense in light of their different stages in the industry life cycle? Yes, it makes sense. From the previous analysis, we know that the medical instrument and supply industry is a risky, yet not so profitable industry before the FDA approval. So in the stage of rapid expansion, for those tech firms, biotech firms, medical firms, we call them unicorn club or some Marvel firms. There are many stories to talk about and pieces of information to gamble on, such as the FDA approval. So the price is on a very high momentum. It's either the overconfidence of investors to become rich overnight, or it's just the stocks are in high demand. while the earning or profitability is not as good as dependable as electric utilities. We know that tech firms always tell news stories before the release of financial reports, such as Amazon and Tesla. And Jeff and Elon are the master in telling stories. So the PE ratio is higher because P is high or P is overvalued, while earning is not as good as dependable as the electric utilities. While for the steady industry like electric utilities, there is not so much to talk about, and earnings per share is very good, or we call it solid. For the dividend yield, which is the dividend over price, the same analysis applies because the medical instrument and supply industry overall has not so stable cash flow as the electric utilities. So the dividend is not as good as the electric utilities. More important, the price is overvalued for those biotech marvels. So the dividend yield is lower than electric utilities. Electric utilities have steady cash flows and dividends, and P is not that overvalued. So D over P is higher. For chapter 18, we review the constant growth model or the Gordon growth model first. So if we rewrite the constant growth model, the dividend as the earnings that are not invested in the firm, this is the plowback rate. And the growth rate is the return on investment, return of equity times the plowback rate. So if we substitute those two elements into the constant growth model, we will get the equation of the PE ratio. This is quite important because in valuation, we always use this ratio as the multiple we based on in stock valuations. So in the next example, we will do valuation for S&P 500. In mid-2012, the forecast for 12-month earnings per share for the S&P 500 portfolio was about $110. The 10-year Treasury bond yield was about 2.9%. As a first approach, we might posit that the spread between the earnings yield and the Treasury yield, which was around 3.9%, will remain at that level by the end of the year. Given a Treasury yield of 2.9%, this would imply an earnings yield for the S&P 500 of 6.8%. In this question, we assume that after we consider the equity risk premium of 3.9%, the return on stock should be arbitrage-free to the return on Treasury. So the return on stocks is simply the sum of the Treasury yield and the risk premium. 3.9%. So if we use earnings yield for the S&P 500 of 6.8%, so 6.8% is earnings over price, which is the earnings yield. And the P/E ratio should be the reciprocal of the earnings yield. So the P/E ratio or the multiple should be 14.7. So our forecast for the level of the S&P 500 index should then be the earning times the earnings per share times the multiple, which should be 1617. Given the current value of the S&P 500 of 1457, this would imply a 1-year capital gain on the index of 160 over 1457, which is 11%. So how do we get this number? This is the valuation we have, which is our expectation of the S&P 500 price. And this is the current price. So if we buy and hold the S&P 500 index, a 1-year capital gain should be 1617 minus 1457, which is 160. This is the capital gain if we believe the price will go up to 1617. So the rate of return is 160 over the current price. For the homework of equity risk premium, we can just use the following formula in the paper downloaded from Canvas, provided by Professor Ricci. And this is the rate of return. This is the dividend yield. And this is the change in shares or the stock repurchases or stock buybacks. This is interest rate, growth rate, and the change in P/E ratio. Just plug in the historical numbers and we will get the rate of return should roughly be around 4.5%. That's all for chapter 17 and chapter 18. If you have any questions, feel free to write me an email. See you next time.